Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about interest rates, particularly rising interest rates, which have a topic that's really dominated the airways over the last week or so. And particularly, I think some investors have been quite spooked by the fact that over the last 2 months, the Reserve Bank of Australia has increased the cash rate by 0.75%, which is, a pretty significant hike. And if you consider the impact of that with the background of much higher prices for goods and services due to inflation, it can rattle a few cages, I think, and get people a little bit concerned. So let's make sure we've got a realistic expectation of, what to expect on an interest rate environment perspective over the coming, say, year or so. Well, in terms of forming those expectations, we can really look to the market and or market commentators such as economists and so forth. And I should note that, it's anybody's guess and, there's been a lot of studies around forecasts and so forth, and it really does show that the reliability is about 50-50. You may as well flip a coin on it, which it suggests. But I guess it's worthwhile at least considering what the so-called experts are predicting. So most of the banks think between now and March 2023, interest rates, the cash rate, will rise between 0.14 to 0.15%. So around about 1.5% potentially in terms of future interest rate increases over the coming months, which is pretty considerable. If you have a look at the money market over the same period of time, so until March 2023, the money market is predicting, or at least the yield curve showing, that interest rates will rise 2.6% over that time. But most commentators think this is a bit hawkish and unlikely to happen, and I'm certainly very much in that camp. So the theory is that due to higher inflation, the cash rate should return to its neutral rate as soon as possible to avoid monetary policy adding inflationary pressures, or adding to inflationary pressures is probably a better way to say it. So the neutral cash rate is when the cash rate is neither expansionary or contractionary. So it's really neutral. It's not really eating into budgets or adding to budgets. And most commentators believe that the neutral cash rate, is somewhere between 2 and 3%. And so if they increase interest rates by 1.5% from here, we're almost smack bang in the middle of that range. Now, if interest rates stay below the neutral rate, essentially what you're doing from a monetary policy perspective is adding to inflationary woes, not subtracting from them, because interest bills for businesses and consumers are below what normalised levels are, or at least what the government would think is normalised levels. Now, the problem is, though, in actual fact, it can cause even more pain for consumers, because not only do they have to navigate higher interest rates, but of course, as been well documented, we've got higher prices as well, higher goods and services prices. Now, the inflation print came in at 5.1% for the March quarter. It's almost certainly going to be higher for the June quarter. And if we look to other developed economies, inflation is approaching sort of 10%. US released their inflation. It's north of 8%. UK is even higher than that. So, and anyone that's been to a supermarket or a petrol station lately knows that actual inflation for a lot of goods is much, much higher than these readings. We're dealing with, in some goods, 30, 40, 50% higher prices. And that really eats into personal budgets. And the higher inflation, together with higher interest rates, is really going to dampen consumer and business confidence. It's already done that. And that in turn, that lower confidence will call economic growth, so GDP growth. Now, the neutral rate might very well be between 2 and 3% when prices of goods and services are at normal levels. But as I said, if prices are high, then the neutral rate might be actually lower than 2 to 3%. And we'll only find out, I guess, through trial and error, but it could conceivably be closer to 1 to 1.5%. So therefore, if the RBA does push through 1.5% of interest rate increases between now and March next year, it is entirely possible that what will happen is there'll be too much pressure on the economy, that GDP will decline, so economic growth will decline, and then the central banks will need to ease monetary policy and start cutting rates. And in fact, CBA last week forecasted that the RBA will actually cut rates by 0.5% in the second half of 2023. And I think that is entirely possible because really demand, as I've spoken about in this podcast previously, is supply driven, not necessarily demand driven, which is not to say that interest rates should normalise as soon as possible. But the problem is that we don't really need to increase them too much because personal budgets are already under pressure. Having said all that, we've got to keep some long-term perspective on this. I mean, I was watching TV last week and they were interviewing people off the street. And, you know, if you didn't have any context, you would be excused for assuming that interest rates had got to 10%. I mean, people were quite alarmist and really worried about it and so forth. And I guess I shouldn't be surprised that, you know, hey, watching commercial television is alarmist. Surely I should have been well conditioned to expect that over the last couple of years. But the reality is that interest rates, even if they do rise by 0.5%, are still below historical averages. So by the end of this month, after the banks have passed on the most recent RBA hike of 0.5%, standard variable home loan rates will be around 4.75%, and investment standard variable rates will be in the low sixes, 6.1%, around about that mark. Of course, borrowers, particularly new borrowers, are always offered hefty interest rate discounts off the standard variable rate, so of around 2% or more. So therefore, most home loan rates will be, you know, high twos, low threes, sort of in that range. If you have a look at the average standard variable rate over the past 20 years, it's 6.36% based on RBA data. But over that period of time, interest rate discounts weren't nearly as high as they are today. So if we take maybe 0.7 off that rate, it gives us an average rate of closer to 5.5%. So we're at sort of around 3. By the time they push through the most recent cut, it's 5.5 is the long-term average. If we get another 1.5%, we'll be up to 4.5%, but still below, almost a full percent below the long-term average. So let's keep it in context. I think the discussion or the rhetoric around interest rates, they're still low. And there's, as I said, a prospect that they will reduce next year. But most importantly, you know, we don't really see, at least at this stage, and I'm always conscious that interest rate expectations can change on a dime, but at least at this stage, we don't see interest rates moving above that long-term average, which I think is good news for home buyers and property investors. Now let's talk about fixed rates. Now fixed rates are really driven by how much the bank can borrow for, so its cost of funds. If the bank borrows some 3-year money at 2%, for example, well, it can afford to on-lend that at 3 or 3.5%. Given the interest rate curve is unrealistically steep, it means that fixed rate borrowing costs for the banks are elevated. And as a result, fixed rates at the moment are unattractive. So 3-year rates are around high 4s, 5-year rates are even above 5%. So certainly not attractive from that perspective. But two things could occur over the next year or so. Firstly, the interest rate curve should eventually normalise. That will happen. It's just a question of when. And secondly, if the market does start expecting interest rate cuts from the RBA, particularly if economic growth slows down, then we may see fixed rates fall. So my general advice to borrowers at the moment is if you're not already fixed, remain variable for now. And maybe it might be worth considering fixing in sometime next year, probably towards the end of next year, I would have thought, but is obviously going to depend on fixed rates at that time. Now, if you already have some fixed rate loans, it's entirely possible that your current fixed rate is, 2% or sometimes even below 2%. And so at this stage, you'd be feeling pretty smart or lucky, or maybe a combination of both, particularly if you fixed your rate last year. In hindsight, that's looking like a really good decision. But of course, all fixed rates mature, and at some point, your interest rate will revert to a more likely, a higher variable rate, and borrowers need to really consider this carefully. And so what I would advise people to do is just pretend you're on a variable rate and adjust your cash flow accordingly, which will mean that it'll promote you to save more, either in an offset account or wherever that might be. But most importantly, it won't be a cash flow shock when your fixed rate does expire. So, for example, if your loan was $1 million and your interest rate was 2%, your interest bill is about $1,600 a month. But now if you had a variable rate, it's probably, if you weren't fixed and it was variable, it would be probably closer to 3% today, which would cost you about $2,500 a month. So that extra $900 odd dollars, you should look at saving and putting in an offset account or investing elsewhere. Ultimately, you're still going to benefit from the low fixed rate and build your asset base. But most importantly, at least it won't be a cash flow shock. Now, some clients have been asking, should I adjust my investment strategy or approach as a result of higher interest rates? Well, firstly, when contemplating, particularly investing in property, but really doing anything such as buying a home, you always must consider affordability at a more meaningful or longer term rate. And from a conservative perspective, I would typically counsel clients to use 6 or 6.5% to really measure their debt affordability. It's possible that interest rates will rise one day above 6 or 6.5%, but if they do, I don't think it's going to be materially above that, nor for that an extended period of time. So if it's doable or affordable on 6 or 6.5%, then go ahead and borrow. If it's not, then what you really got to do is really reconsider your strategy to either reduce your borrowing budget or invest in alternative assets. But really, just because interest rates are rising, again, albeit below the long-term average, doesn't necessarily mean if you've got a well-considered strategy that you should make any changes. Now, I've included a chart in the link in the show notes, which project how sensitive investment property cash flow is to interest rates. And so what it does is predict the after-tax cost of holding an investment property at various interest rates between 2 and 6%. And you can see how sensitive it is. And hopefully what it does is forewarn investors to make sure that they're prepared for the eventual higher holding costs if they're looking at a prospective investment. So to sum up then, I think we've got to be prepared for higher interest rates over the coming months. I think we've got to be prepared for the RBA, increasing at a much faster pace than they have previously. I think that's going to have a negative impact on the economy, particularly from an economic growth perspective. And that pain will really be centred on lower income earners because they don't have as much sort of fat in their household budgets to accommodate both higher interest rates and higher prices, particularly for non-discretionary items like food and utilities and those sorts of things. But ultimately, the economy's in pretty good shape. And if it does struggle, I'm sure the RBA will react accordingly because their goal is to keep inflation sustainably between that 2 and 3% band. So if they start seeing that they've pushed rates too high too quickly, they can always react and cut rates. But most importantly, the underlying economy is still very healthy. And whilst it might be a bit of a bumpy road over the next year and a bit, we should take some solace that firstly, interest rates are expected to remain below the long-term average, which creates a great opportunity for investors. And the underlying economy is pretty sound. So once we find that neutral interest rate, whatever that is, depending on circumstances and inflation, the economy should perform in a robust manner. Okay, so that's it. So I'd like to sincerely thank everyone for listening to the podcast and just remind you, if you do leave ratings or reviews, hopefully 5-star, it certainly does help with the rankings and I appreciate it. That's it for me for this week. Bye for now.